So welcome everyone. I'm Gavin Martin from Cornerstone Wealth, and I've got Phil Watson, the digital marketing coordinator online. We're talking about capital gains tax and maximising your estate to benefit your family tonight. Thanks for joining us. You can ask questions via the chat, thanks again for being online, and thank you to Phil for introing.
Yeah, no worries, and thanks, to you guys out there, Christian Super members. Like we sort of say this a lot, but we pray for you guys, and we're always here to chat, and we want to serve you, and we don't just say that because we have to, but we actually, we were praying for you guys this morning, as en masse. But let me just pray for this session tonight.
Thanks, Phil.
So Father, we just ask for your help tonight, that you'd be speaking to us as Gav shares these tips. Lord, we just ask for whichever stage of life we're at, we ask for your continued wisdom. We thank you that you're a God who always has new things in store for us. And I just ask for that we'd be able to hear the stuff that we need to hear tonight, and that you'd even be just there's natural wisdom here, but you'd just be adding to the wisdom that we get, so that we can all have a purposeful retirement. We just thank you for Gavin. We ask for your blessing on his family, and in fact on everybody who's listening to this, both now and the recorded version later, in the mighty name of Jesus. Amen.
Amen. Thanks again, Phil. Just a compulsory disclaimer that the advice that we're providing tonight is advice of a general nature, so please seek personal financial advice before making any decisions. If you are seeking personal financial advice, the way that we can assist you in doing that is that we generally have you complete a questionnaire. We then meet with you for an initial consultation where we talk about your goals, look at your current situation, and then talk through the pros and cons of the range of options available to you. If it's warranted, we can provide you written advice. That's where we get to the personal advice stage, where we need to put it in writing. We can help you implement it and provide ongoing advice. So you can take that process as far as you need to or get value from. So tonight we're talking about two main topics. One is capital gains tax and how to minimise it if you're selling an asset. And then secondly, maximising your estate. And specifically, we're talking there about what we call the cash out recontribution strategy. But to kick it off, for those people that are interested in how to minimise the gain or the tax on the sale of an asset where you've made a profit, the first thing is to understand what a capital gain is. And it normally occurs on the sale or a transfer of an asset. So it could be that you're transferring an asset from your own name into your super fund, or it might be that you're selling an asset. But on either of those two events, it's generally the case that there's that's where a capital gains tax event is triggered. And a capital gains tax operates by the net gain being treated as taxable income. So it's added to your taxable income and then applied at your marginal tax rates. It applies in the year that the asset is sold, transferred, or disposed of. And in particular with property, it's important to note that when you sell property, it's the contract date, not the settlement date, that's generally used. So if you contract to sell it in June, but your settlement's not until July, the actual year in which the gain is triggered is the contract year. So it'd be in the June financial year, not the next financial year in July. And if the asset is held for longer than 12 months, the amount of gain is discounted by 50%. And in super funds, it's discounted by 33%. So $100,000 gain would be discounted to $50,000 in your individual name, or $100,000 gain would be discounted to 67 or 66.6% in a super fund. So the effective tax rate for capital gains in a super fund is 10%, because it's 33% gain or 67%, and then 15% applied to that gets to a 10% effective tax rate. Obviously, in pension phase, you don't pay tax if you've satisfied a condition of release. So that's what a capital gains tax is. And ask questions as you wish to via the chat section as we go through. How you can reduce capital gains tax is, firstly, remember that there are some exemptions. So the main exemption is your principal place of residence. So if you've bought a home, you've lived in it since you've bought it, and then you sell it, it's generally your primary place of residence, principal place of residence, and is exempt from the capital gains tax. There are a couple of other exemptions. One is if you apply small business CGT exemptions, you've got to satisfy the rules to do that. So it's if you're running a business and you've sold it, there's lots of criteria that need to be applied to that. So you really need your accountant to be involved with that. But if you are selling a business, you might be able to sell that without paying any capital gains. And the other one is if the asset that you've bought was purchased before the 20th September 1985, that is also prior to capital gains tax. So if you sold the asset, there would be no gain applicable either. So there's the three main exemptions. And how you look at reducing the capital gain is either selling in a low income year. So you could potentially retire in July and then sell an asset and you've got next to no income. And therefore, if all of your taxable income is made up of the capital gains tax event, then that will reduce the amount of gain applicable. The other ways to reduce your taxable income are by salary sacrificing or making personal deductible contributions. Now we're going to talk through those two. And we'll also mention the superannuation catch-up rules that are useful from the 1st of July 2019. And you could sell assets over multiple financial years. And I guess that's more so applicable for the likes of shares as opposed to real estate, but you could stagger it if you were wanting to sell an asset. So often we've got bank shares and in particular CBA shares that people are holding and potentially want to get that money into super, but it's difficult because there's these massive gains associated with it. So you often sell them over in multiple financial years and then you minimise the capital gains tax applicable there. And then the other thing is you can offset capital gains with losses. So if you've got some share losses and you sell those shares and then sell a property that's got a gain on it, then you can offset those against each other, and so it reduces the gain as well. But let's look at an example at how it works. So if you've purchased a property, for example, that was cost you $400,000, and then a couple of years later sold it for $500,000. So you've effectively made a $100,000 profit. Now that's the gain. That's the capital gain of $100,000. Now, if you've held it longer than 12 months, then the gain is discounted by 50%. So your $100,000 becomes $50,000. And then in this case, the home was owned jointly by Joe and Mary. And so that $50,000 is directed to each of their taxable incomes for that financial year. So the $25,000 is added to Joe's taxable income. And in this case, Joe has got, for the financial year, Joe's got wages of $77,000, interest of $10,000, and then we're adding in this capital gain of $25,000, which is half of the $50,000. And the additional tax that he'll pay on that is just under $10,000. So the tax associated with the gain is $10,000. Now, Mary, his wife, is in a different scenario. She's not working. She's just got some interest income of $37,000. If we add the $25,000 to that, the tax on that is $8,670. So in total, there's tax of $18,600 on the $100,000 gain that they've made on the property. Now, the question is, how can we reduce that? One question that has been asked in the past is, on my investment property, I usually claim a certain amount of depreciation each year. If you have been doing that, then that effectively reduces your cost base or your purchase price. So if you've held the asset for 10 years and you've claimed depreciation of $10,000 each year of those 10 years, then your cost base here would be reduced by $100,000 to $300,000. Your gain end up being $200,000 and so on. So if you claim depreciation, it does reduce your cost base and therefore increase the capital gain. So how do we reduce that $18,000 in tax on the $100,000 gain? We'll look at Joe first, and what we're suggesting here is that if Joe's salary sacrifices up to the $25,000 contribution limit. So this column is no salary sacrifice. So all he's got is his wages and interest of 87. We had the discounted capital gain, the 25,000. So his total taxable income is 112, and tax on that is just under $31,000. Under the salary sacrifice scenario, we are factoring in his income at $77,000. He's got to pay 9.5%. Or his employer would have paid 9.5% of that 77 into his super fund. So we've got capacity of 17,685 that we can salary sacrifice into super. And by doing that, we're reducing the taxable income by 94. We then reduce the income tax to from 31 to 24, or just under 24. We do pay 15% contributions tax on the 17,600, but still overall the tax is reduced from 31 to $26,500 for a net tax saving of $4,500. So that's a great outcome for Joe, as he's saved that $4,500 in tax by making those salary sacrifice contributions. But one thing that Joe would need to be careful of is if he sold the home quite close to the end of financial year and hadn't factored in that he was going to sell the home and therefore didn't salary sacrifice, then if you sell it, for example, in June, and you've only got, or in May, for example, and you've only got 1 month's salary, he's only going to have $6,000 or so that he can salary sacrifice for that 1 month that's left in the financial year. So if you're using the salary sacrifice method, just think about planning ahead. Even if you sell the asset late in the year, if you know that you're going to sell it, then you could potentially start salary sacrificing. So it's better to push out your time frame that you can utilize a salary sacrifice by either selling the asset early in the financial year, or if you know you're going to sell the asset that financial year, start to salary sacrifice in preparation for it. So just be wary of that. In Mary, her case is different in that she's actually not employed, so salary sacrifice isn't an option, but there is the option of personal deductible contributions. So if she did nothing, she would have 37,000 of interest income, 25,000 discounted capital gain, total taxable income of 62. So the total tax there would be 12,337 if she did nothing. Whereas if she made a personal deductible contribution, where she puts 25,000 into a super fund and then claims a deduction on it, it basically reduces or wipes out the $25,000 gain. So her taxable income is really just the interest income of 37,000. The tax on that's 3,667. There is some contribution tax, the 15% of the 25. So the total tax that she'll pay is 7,417, but it's nearly $5,000 less than she would otherwise pay. So between Joe and Mary, by making the salary sacrifice contributions and the personal deductible contribution for Mary, they've been able to reduce Joe's nearly 10,000 in tax down to 5,400 in tax, and Mary's reduced her 8,670 down to just under 4,000 in tax. So the 18,000 is total tax is more than halved to 9, so a total saving in this case of $9,429. So well worthwhile considering. If you are selling assets, whether it's shares or investment property, it's well worthwhile considering these types of strategies. Now, one thing to factor in is that most of you have probably heard that the Labor has announced that they're going to reduce the discount on capital gains. So this 50% discount that we've factored in this scenario with Joe and Mary will reduce to a 25% discount. So the $100,000 profit on the property would then not be discounted at 50, but be discounted at 75. And if that then flows through, the 25 added to Joe and Mary's taxable income would be 37,500. And if you follow that through, the nearly 10,000 becomes $16,000 tax liability. the 8,670 becomes 13, nearly $14,000, etc. So it's basically the proposal to reduce that discount means that there'll be more tax payable on the sale of assets. You can still benefit from these strategies, but if I can just get to the next bit, yeah, you're still paying significantly more tax, so $30,000 versus 18 if you don't apply any strategies, or if I can get it to come through, the $30,000 can be reduced to $18,000 with this these two types of strategies that we've applied. So we can still save. So we're saving more tax because we're on a higher tax threshold, but still the difference would be that you'd be paying sort of nearly double the tax under Labor's proposed policy. Now, one thing to factor in is that the proposal currently is that they won't make it retrospective. So if the Labor Party gets in at the next election in the next month or so, the proposal is that this change to the from a 50% discount to a 25% discount won't be retrospective. So if you've owned the asset, and they haven't said exactly what date it is, but it might be, I think that people have floated or suggested that it might be the 1st of July 2019, that if you've owned the asset before then, you'll be under the old rules. And if you purchase an asset after then, it'll be in the new rules. So people are suggesting that there might be a bit of a flurry to purchase property over the next little few months, to avoid this lower discounting on assets. But it's all a bit speculative because there's no specific policy that's been set in concrete, and then you don't know whether Labor will get in or not, even though they're favoured to. So that's one change that is proposed by the Labor government. Now, just to be aware, when you make personal deductible super contributions, that you need to just satisfy a few rules. One is that you need to make it to a complying superannuation fund. Can only be claimed in the income year that the contribution is made. So you need to make sure the contribution is made within that year that you trigger the capital gain. You need to be, you can't be more than 75 years of age. And if you are at that age, you've got until the 28th day after your day of the month after you've turned 75 to get the money into super. But you also need to satisfy the work test. If you're over 65, you need to satisfy the work test, which is working 40 hours in 30 days to get contributions in. And you must have lodged a valid notice of an intent to claim the deduction before you submit your tax return. Another thing to factor in. You must be entitled to contribute to super, so you're either under 65 or you're over 65 and satisfied the work test, 40 hours in 30 days. And previously, you needed to satisfy a work test of less than 10% of your income coming from employment purposes. But that was abolished on the 1st of July 2017. So it's been a lot more flexible over these last couple of years to make these personal deductible contributions, because even if you were only receiving employment income, you could still make these types of contributions. Now, Labor has also proposed to, it's not clear whether they're going to abolish deductible contributions altogether, or whether they're just going to go back to this 10% rule that was previously. But it'd be disappointing if they went down that route, because it's so much more flexible and even for employed people and self-employed people to utilise these types of deductions. But just factor that in. So how it works with personal deductible contributions, you need to, I guess, factor in the timing of when things occur. This should actually be 20th of September 1985. So it's basically saying it's a CGT asset. So you've purchased the assets, it costs $400,000. 12 months later, you've sold it, and the discounting applies. You've sold the asset for $500,000. You might get $50,000 as a deposit. If you're able to release that deposit, you might be able to put your contribution in, $25,000 each potentially into super prior to the 30th of June. But yeah, you might be wanting to also put other contributions in. So if you're wanting to sell the asset and get the money into super, which is often a strategy, you need to factor in the timing of the funds coming through. So you get your $50,000 that you could put in as a personal deductible contribution. You then might get your forward at $150,000 at settlement, and you might be able to get that in before the end of the financial year as well, as a non-concessional contribution. But in terms of how the personal deductible contribution works, get your contribution in. After the end of the financial year, you submit your intent to claim a deduction form to your super fund. The maximum at the moment is the $25,000, but you need to factor in superannuation guarantee contributions. Once you've got confirmation from your super fund that that deduction has been claimed, then you can submit your tax return. Don't submit your tax return here before you've got confirmation from your super fund that the claim of a deduction has been made, because if you do that, you then muck up the strategy. You can't actually get the deduction. You can't wind it back. If you've made your processed, or your super funds processed the intent to claim a deduction form, and then you submit your tax return without having included the claim in your tax return, you can resubmit it, but you can't if you've done it in the wrong order. You haven't actually processed the claim first. It often causes issues, so just be aware of that. There is a strategy that is starting to apply. You can't take advantage of it this financial year, but you can next financial year, which is the carry forward rule, or the catch up rule, sorry. And this is where if you've got larger capital gains that need to be dealt with, in this example we've got, rather than a $400,000 property, we've got a $320,000 property that's grown to $1 million. So, and that feasibly, it could be feasible in the major capital cities over the last few years, probably more than a few years, but over the longer term, you may have those sort of gains on your property. What you could potentially do is, if you sold it out into the future in the 2023-24 financial year, you may be able to take advantage of this catch-up rule where you can use your $25,000 contribution limit. If it's not been used over the last few years, you can use it all in that 2023-24 financial year. It's sort of planning to the hilt, and you're not likely to be able to plan around using it until you get to that year, but it might be something that you could factor in. So if you've got $1 million property you bought for $320,000, and so you've effectively got a profit of $680,000. If it's owned jointly, you're splitting that $340,000. Sorry, we've discounted it to $340,000. Then we're splitting it between Joe and Mary because they own it jointly. We're effectively adding $170,000 to Joe and Mary's income. But in this case, we're assuming that they're retired and they're not actually generating any other taxable income. The tax on that would be around $56,000 each, so about $112,000 in total. What they could potentially do is use these catch-up provisions. If they haven't made contributions, those deductible contributions, or had superannuation guarantee contributions, they could actually claim a full $150,000 deduction in a single year. It would need to be in that 2023-24 financial year, but that would mean that rather than paying the $56,000 in tax, they'll be paying only contributions tax, so of $22,500 each, which would then reduce their full tax liability of $112,000 down to $45,000. So a great saving of around $68,000 in tax. Now, how that works is, so the catch-up rule is, basically, here's Mary, $170,000 discounted gain. If you just paid the tax on it, it'd be worth $56,000 in tax that should have to be paying. What we're looking at doing here is using the catch-up provision, so 6 years of the $25,000 contribution limit being used in a single year. Means that the taxable income is $20,000, which is below the taxable, it's the tax-free threshold is effectively $20,500. So there's no income tax payable. All you're paying is the 15% contributions tax on the $150,000. Debbie's just saying that the sound is dropping out regularly. Is everyone else okay? Is it my end, or is it just is it Deb's end? If anyone can just let us know via the chat section, that'd be good. Sorry, Deb, that you're experiencing those audio troubles. So the total saving there. So Jenny's saying it's okay there. So thanks for that. And Jeanette, it sounds good. Thank you. So it might be your connection, Deb. Sorry about that. So this is and so how this works, if you look at this is the catch-up rule and how it would need to be used. So it starts to accrue if you haven't used your deductible contribution limit. So to not use it, you would have to be not employed because your 9.5% superannuation guarantee that your employer puts in utilises some of this $25,000 limit. So you would need to not be employed to fully utilise this. But basically, if you've got a $25,000 limit each year, if this financial year you don't use it, you've got 25 unused, so it can be carried over to the next year. So each year we've not made any contributions, and so they roll over until the 2023-24 financial year. We could actually make that $150,000 contribution to super, claim it as a deduction, and you'd potentially save that significant amount of money on a gain, on a capital gain. So that's how it can work in this scenario. But if you're employed, let's look at another scenario. So if, for example, you were on $105,000 and your employer was putting in 9.5%, the statutory amount, you'd be putting in $10,000 superannuation guarantee each year. So if that happened in this financial year, there's only, your employer put in 10, the limit was 25, so unused was 15. And that would roll over to the next financial year. If you took some time off, whether it's maternity leave or whatever it is, then you haven't used any of the contribution limit, then the 25 would add to the 15 to get 40. Again, if you haven't worked, you'd add another 25 to get to 65. And then if you worked, but it was, then you claimed a deduction, for example. You might have sold an asset. In this financial year, you could claim $85,000 deduction. That means that there's 5 that's unused, and so on. So it basically rolls over each year, but it's for a rolling 5-year period. So if you got to the and again the 15 grand has been unused. If we got to the 24-25 financial year, then this $15,000, if it was unused, would drop off, and so it's for a rolling 5-year period. But it could be a benefit at the 23-24 financial year for someone selling an asset with a significant gain associated with it. The thing to be worried about here is that it is Labor's policy to abolish this catch-up rule policy. They're going to eliminate it altogether is the policy that they're taking to the election. So it won't be possible if Labor is elected and it does implement it, does get the changes through Parliament. Any questions there at all about capital gains tax? That's the main section that I was going to cover off there with capital gains tax. So if you've got any questions, then now's a good time to ask them. Actually, there was a question from someone that I haven't got in here. Yeah, actually, here's the question. I've put it in the wrong order here. I just did have a question from Emilio, and he asked a number of questions about capital gains tax that might apply to others as well. So his question was, is there an age limit beyond which CGT doesn't apply anymore? The answer is no. In fact, even after you've passed away, the liability is passed on to the next generation or your beneficiaries. It's the hidden death tax. Capital gains tax is the hidden death tax. So no, there's no age limit. It applies through till death and passes to the next generation if you haven't sold the asset. That's unless it's purchased prior to the 20th of September 1985 and it's a pre-CGT asset. The next question was, if I want to transfer property to my children, does CGT apply? Yes, that's a CGT event when you're transferring as an asset to another individual or entity. And the question is two parts of it. It's a CGT event. If it's your own property, your primary residence, then you're selling it and the exemption applies. So there'll be no capital gains tax payable to you, by you. You just need to pay the stamp duty to transfer it to your kids. So it wouldn't be a capital gains tax event. Whereas if it's an investment property, it would be a capital gains tax event. So there'd be capital gains tax would apply and you'd pay the stamp duty. Now, the second question is, if I die, it's the same thing, same rule applies, but stamp duty doesn't apply. So the next question that Emilio had was, if I die and then my children inherit my property, does CGT apply? No, if it's your primary place of residence, you've got up to 2 years in which you could sell the asset and capital gains tax won't apply. It's a CGT event, it's an exemption. But if it's an investment property and you pass it on to your kids, there's not normally stamp duty, I think, in most states, because if it's part of the will, stamp duty won't apply, but it'll be your beneficiaries, whoever inherits the property, will inherit the cost base. If it's purchased prior to the 20th of September 1985, it's a pre-CGT asset. The value as at the date of death is generally will be the cost base. So it'll be a CGT asset until the time that it's sold, until the date that it's a CGT. Until the date of death, and then at that point in time, you'll inherit the cost base as at the date, or the valuation as at the date of death. But it's not. You don't have to pay capital gains tax until the actual asset is sold. The other question was, if I make a loss selling some shares, would the loss be offset any gains made on an investment property during the same financial year? And the answer is yes. You offset the gains and losses before you discount the gain. And then what's the long-term forecast regarding CGT policies? The main one is the one that we've already talked about, where the Labor's policy is to reduce the 50% discount if an asset has been held longer than 12 months, reducing that discount to 25% rather than 50%. That's the main policy. Just relating to capital gains tax, Christine's asked, we purchased the family home prior to 1985. Do we face CGT on improvements made post 1985? No, I wouldn't think so. And you're probably falling under two exemptions, though. One exemption is the fact that it's your family. One is that it's purchased prior to 1985, and then secondly, if it's your home that you live in, it's an exempt asset anyway. So it looks like you'd be exempt on two fronts there, both on being the primary place of residence and the fact that you purchased it prior to 1985. Thanks, Christine, for the question. Let us know if there's any others before I move on to the next section, which is the cash out recontribution strategy. Actually, I think this slide is the slide that I meant to include down the bottom here. So now, what we're trying to help you with here is a strategy that we regularly implement around retirement. So it's at a point in time when you've got access to your superannuation money. You might have retired and you can fully access it by tax-free by drawing it out. It's a common strategy that we apply, and it doesn't really help you as a couple or an individual, but it helps the next generation by reducing the death benefit tax that they might pay. So let's have a look at it. Your superannuation is made up of two types of components. One is taxable components and one is tax-free components. Now, the taxable components are made up of your employer superannuation guarantee contribution, so the 9.5% that your employer puts into your super fund. And then there's an additional, so if you made additional contributions like salary sacrifice or personal deductible contributions, then they go in as concessional contributions and are considered the taxable component as well. So once they've gone in, they're then defined as what we call tax components. And if they pass to a financial non-dependent, so if they pass from you as an individual or a couple to your adult children, then those components are taxed at 17%. And then there's what we call post-tax contributions, and these are non-concessional contributions. So they might be like the $1,000 that you put in to get the government co-contribution, or other types of contributions that you've made. Now, those types are considered tax-free, and they transfer to your kids without paying any tax at all, adult children without paying any tax at all. So the question is, how do we increase those tax-free components and reduce the tax elements of your super fund so that it benefits your kids? So let's look at some numbers first, and it probably helps explain things. So looking at the same concepts, your superannuation guarantee contributions and salary sacrifice and personal deductible contributions of your account is $100,000. So you've got a balance of 120. 100 of it is what we call taxed components. So if you pass away and they go to your kids as a death benefit, then they'll pay 17% tax. So rather than them getting the full 100,000, they'll get $83,000. And for the other $20,000, it's tax-free, so it'll pass to your kids without paying any tax. So of the $120,000, your kids will get $103,000. So how can we help them get the full $120,000? What we do is when you've got access to your superannuation money, and this is when you've satisfied a condition of release. So you've turned 60 and you've ceased a form of employment, or you're under 60, you've reached the preservation age, which is currently 57, but it's increasing up to 60 depending on your date of birth. If you're under 60, you need to have ceased work and you intend not to return to the workforce. That's how you satisfy a condition of release and get access to your money. And what we do, you've got access to your super money. If you're over 60, you can pull it out and there's no tax payable on it at all. So we basically withdraw it from your super fund, put it into your bank account. So now it's just $120,000 sitting in your bank account. It loses all its components. It's just cash in your bank. And then that $120,000 can then be, just press the back button rather than the front button. That $120,000 can be then put back into your super fund. But this time we recontribute it as what we call a non-concessional contribution. So then the component is a tax-free component. Then if it passes to your kids, it passes to them tax-free, and you've effectively saved that $17,000 in tax. Now, a lot of people, so I think the average superannuation balance for a male retiring at 65 about 8 years ago was $120,000. I think that's why I originally chose that for this presentation. But many people have got balances well above that. So if you're able to clear those components, it can be $100,000 that you're saving in tax that can pass to your kids, and I'm sure that would be of benefit to them. So yeah, well worth considering. But you need to make sure that you can get the money back into superannuation if you have drawn it out as well. So there's a few tricks and traps along the way. The key one is that if you're below 60, you can withdraw up to $205,000 of taxable components without paying any tax. But once you turn 60, all drawings are generally tax-free from super, so just be aware of that. You need to be eligible to recontribute the funds back into super. So this is currently the non-concessional contribution limit is $100,000 a year. When you're under 65, you can bring forward 2 extra years to put in $300,000 in any 1 year. So if you're looking at a couple, that might be $600,000 you can put in. If you do it 100 in June and then 300 in July, that means that you can effectively take advantage of maybe getting $800,000 back into super. So depending on your age and how much of your contribution limit you've used in previous years, you can generally get a fair bit back into super. Labor has also proposed to reduce that $100,000 to $75,000. So they're sort of tightening up around the superannuation rules. So they're proposing to reduce that $100,000 to $75,000 as well. So if they get in and you're thinking about this strategy, then you need to factor that in as well. And then the other thing is, if you're expecting an inheritance, often we hold back or we stagger this process so that that we don't utilise the contribution limit unnecessarily, because sometimes it's better to keep the money in the tax-free superannuation environment, and then if you get more funds from an inheritance, you can still get that money into super as well. So if you're expecting inheritance, we kind of sort of stagger it and maybe don't use the bring forward rule that to do that. So yeah, that's the cash out recontribution strategy. We implement it regularly. It's well worthwhile doing. As I mentioned earlier, it doesn't actually help that much for you as a couple, because if you both have a superannuation account and you have a binding death nomination established with that, so that you're directing it to your spouse, because your spouse is a financial dependent, it goes to them without paying any death benefits tax. It's just if you either both pass away or the surviving spouse, or you're an individual, you're single, and that passes to a financial non-dependent, that's where the death benefit tax starts to apply. So yeah, it can save your, you can pass on a lot more to the next generation by implementing that type of strategy. If you've got more questions, or for the likes of Deb, who had a few sound challenges, the recording is available on our website. Just go to cornerstonewealth.com.au/retire 2019. Feel free to email through questions as well if you have them. The next webinar, where we're talking about Centrelink and the age pension. So we'll go through the basics, a bit of a comprehensive basic rundown of Centrelink and the age pension, how the income test and the asset test works. The one after that is about strategies to maximise your age pension. So they're two, I guess, Centrelink related webinars coming up. So the next one's on the 22nd of July. If you, the second one I think is in early August. If you are looking at retiring and you've a spouse that, and you're a couple and one of you is significantly older or younger than the other, the second webinar is well worthwhile checking out, because it's got a strategy there that we regularly apply that is very advantageous. So they're the upcoming webinars. Hopefully the content we just ran through this evening has been beneficial. Let us know if you've got further questions online, and obviously you can go to the Christian Super website. If you call their help desk as well, they've got online advisors. So through their administrator, there's online or phone-based advice that you can get there. Otherwise, you feel free to give us a call as well. I posted a question, Gavin. Philip, I might have missed that, adding it to the webinar. If you're able to just send it through the chat section, I'll answer it for you now. And feel free, if you've got further questions, I'll stay on for as long as we have questions. So fire away, just using that chat section on the actually, I've not been looking at the Q&A section. There's two different spots. Oh, Philip, there you go. Thanks. It was through the question spot, not the chat spot. So Philip asks, is going to a pension fund account another way to save the kids' tax on inheritance? It is to a degree. So if you've satisfied a condition of release and you move to the pension phase of superannuation, what that means is that any capital gain and any income earned within the pension phase of superannuation is tax-free. So if you're thinking about the option of either investing in your own name, so you've got $500,000, you can invest that in your own name, or you can invest that within the pension phase of superannuation. We would generally say go for the pension phase of superannuation. And one of the reasons is that if you invested it in growth assets like a share portfolio, and that $500,000 in your own name grew to $1 million, and then you passed away, then that $500,000 gain would be passed on to your kids or whoever your beneficiaries are. And so someone would have to pay some tax on that $500,000 gain. If you put that $500,000 into the pension phase of superannuation, then it's a tax-free earning environment, so that if the balance of that went from $500,000 to $1 million, that $500,000 gain is tax-free. It's a tax-free environment. So that's the benefit of the pension phase of superannuation. So I think you're along the right lines there. But as we just talked about with that cash out recontribution strategy, that $500,000 in the pension phase, if that's mainly made up of employer contributions and salary sacrifice contributions, then you might still pay the 17% death benefits tax, or your beneficiaries might. So if you can complete that cash out recontribution strategy along the way, that's a great way to have tax-free earnings, tax-free drawings, and tax-free to your kids. That's kind of where we like to aim for, that type of approach. Thanks, Phil, for the question. Anyone else with other questions before we go? Peter is asking, we have a commercial property held by a company that we have. We have a commercial property held by a company that we have set as trustee for a family trust. Oh, yep, so in a family trust. If we make a capital gain through the sale of the commercial property, is anything different? Would a Labor win change anything? Yeah, really good question, Peter. So there's a couple of changes. If you hold it within a trust, if you trigger a gain and then you distribute it to individuals, it's effectively the individual's tax rates that apply, and you can apply the discounting. So, yeah, good question. So under the current rules, let's say that Labor's not in power, under the current rules you would get the 50% discounting, and you could distribute it to the beneficiaries of the trust and utilise their various marginal tax rates. So two things might change if Labor got in. One is that they might reduce the discounting to 25%, but they've said that they won't be retrospective. So you would suggest that the 50% discounting still should apply, because you've purchased it prior to them introducing the 25% discount. So that shouldn't change. What they have also announced, Labor have announced, is that trust income will have a minimum tax rate of 30%. So I'm not 100% sure how it's going to work, because it sort of announced it without a lot of detail. But if you have a family trust and you're previously could distribute to the beneficiaries with no taxable income, for example, and you'd be able to direct, say, $20,000 to them tax-free. Labor's proposal is that a trust would have a minimum tax rate of 30%. So it would significantly reduce the benefit of trusts. They're saying that they will exclude the likes of farms, but all other trusts will be included in this initiative. So if you have a trust, minimum 30% tax rate. That also is a concern, because a lot of people who don't utilise the superannuation environment because they're too young might have a trust in place. We often use them for someone that's a long way away from being able to access superannuation. We use a trust, and they can actually use that trust to direct profit or investment income to church and charitable organisations pre-tax. And so if Labor introduced this change, then charitable and church organisations will be negatively impacted, because they'll be paying a minimum amount of 30% tax prior to distributing it. So yeah, there's a range of negative announcements around tax and superannuation that Labor are introducing. I think because they're it's likely that they'll get in, that they're just putting all these policies in place and saying that if they get in, they'll probably just say that they've got a mandate to implement them because they announced them prior to the election. Yeah, so good question, Peter. Thanks for that. Any other questions at all? Just checking. So Miko is, if money is withdrawn from super, what is the difference between leaving it to and putting it back as non-taxable contributions? If money is withdrawn from super, what is the difference between leaving it out and putting it back as non-concessional contribution? Oh, so if you're pulling the money out of superannuation and you don't put it back in, it's fine to leave it outside, but you just run into those challenges like I talked through with Philip. So that the biggest thing is if a couple can have like $1 million. Well, previously you could have $1 million of investments, and as a couple invested in your own name, and you wouldn't pay tax, because once you're of pension age, the tax-free threshold's about $29,000 each, and so your $1 million could be earning 50, 60 grand, and you wouldn't pay any tax. The drawback is that there might be capital gains tax. So if your $1 million in shares, for example, grew to $2 million, then there's $1 million gain that you have to pay tax on at some point. So the benefit of putting it back in again to super rather than leaving it out and invested in your own name is mainly along the lines of that capital gains tax. Yeah, it's difficult when people are in their sort of 75 to 90 sort of range, and they're paying tax on their investment income because it's all outside of superannuations. There's not a lot you can do. You've just got to wear the tax. So if you can get the money in when you are eligible to put it back into super, then we usually take advantage of it. Ken asks, when he's putting money back into, I'm assuming superannuation, subject to 15% contributions tax, and when does it go in tax-free? Yeah, what you're talking about there, Ken, is the difference between what we call concessional contributions and non-concessional contributions. And there's two different limits. The concessional contribution limit is $25,000, and if you there's 15% tax payable on the way in when you make concessional contributions. But what it does is it reduces your taxable income by the same amount. So the benefit of doing it is the difference between your marginal tax rate. We went through this in the previous webinar, the transition to retirement webinar. So if you want to look at this in a bit more detail, go to that cornerstonewealth.com.au/retired 2019, and it'll explain this in a fair bit of detail. But you pay 15% tax on concessional contributions, and the benefit is that that's better than paying your marginal tax rate if you're earning more than $20,500, and that's the benefit. If you don't need to, or if you've used up your $25,000 threshold, or you're completing a cash-out recontribution strategy, then it's non-concessional contributions that you want to make, because if they pass on to your kids, then they go to your tax-free, and there's no tax on the way in. A bit of a long-winded and a roundabout explanation there, Ken. Let me know. Follow up with further questions if I haven't quite hit the nail on the head there. Jeanette asks, is there a set time that you need to hold your super withdrawal in the bank before you reinvest it in super? No, it just needs to go out and then it goes back in again. There are some retail funds that actually facilitate it without actually going out to your bank account. They just facilitate it going to like an investment account within the structure and back in again. But yeah, it just needs to go out of your bank account. It then clears the components, and then you can put it back in again. Again, just making sure you stay within your limits, the non-concessional contribution limit. Thanks, Jeanette. How do we find out what the breakdown is of taxable and non-taxable in our super. I can't find it on my annual statement. Yeah, I often look for it on the annual statements of a range of funds. I think Christian Super doesn't include it on theirs. But you can look at it online. So if you go, I know that on the member online account, if you go to a benefit statement, then it will show you the taxable and tax-free components there, or you can call up and they will give it to you over the phone as well. But you can, if you haven't made large contributions into your super fund, like non-concessional contributions into your super fund, generally they'll be taxable components. But what you do, if you look at your statement, or if you look at it online and you've got a $300,000 account and $290,000 of that is taxable components, 17% of that $290,000 would be paid as a death benefit if the money was passed on to non-financial dependents like adult children. Yeah, that's a good question. Philip's just saying thanks for the session. You're welcome, Philip. My pleasure. So any other questions? Doesn't necessarily need to be about capital gains tax and cash out recontribution strategies. Let us know if there's anything else that you want to cover off before I wrap up. Ken just asked a really interesting question. Yeah, yes. So Ken asked, are you better off cashing? Are you better off getting cash out before you die? And yes. So this whole cash out recontribution strategy is basically trying to avoid the need to do that, because if somebody is ill or passes away quickly, normally you're not in a family, and you yourself, if you're on your deathbed, and not really thinking about your finances, and you're not really a concern. So you don't think to actually draw your superannuation out of draw out your superannuation and put it in the bank. But if you did do that, that also enables you to avoid that 17% tax, because you're alive, you're over 60, you've drawn the money out of your superannuation and it's in your bank account. And therefore you avoid that death benefits tax. The challenging thing is that, it's around the time of illness, and or if it's a sudden passing away, then that's where the challenge of that is. But it is an option to avoid that 17% tax. Yeah, good point. And the follow-up question for Ken was, and giving it to dependents. If you are still alive, you can cash it out from superannuation. That avoids the 17%. If you give it to dependents, the benefit of that will be dependent on whether you're on the age pension or not. If you've got too much in terms of assets, so you've got over 800 and I forget the exact figure, $840,000 or $50,000 in assets, then you won't be receiving an age pension, and you can withdraw the funds and pass it on to dependents without any issue. But if you are on the age pension, if you pass it on to dependents, then you'll be caught under the deeming rules. You'll be you can gift $10,000 a year or $30,000 over 5 years and it not be caught up in the deeming rules. But if you give more than that, then Centrelink will record it as if you still have that asset, the amount over those thresholds. So you can still give it to your dependents, but you just won't, your assets won't reduce for Centrelink purposes, and therefore your age pension won't increase. But you can certainly do it. There's nothing stopping you from doing it. Yeah. Okay, we're just about clicked on 9:30, and I think questions have dried up nearly. Miko's just saying thank you very much. My pleasure. Thanks for joining us, Miko. Last call for a question before we wrap up. Christine just says thanks. You're welcome. Okay, so I think we've run out of questions. So thank you very much for joining us. I hope you have a great evening. And if you are in that space where you wanting to understand the age pension, then feel free to join us on the for the July webinar. Any other information, all the recordings for this year will be on that webpage, cornerstonewealth.com.au/retire 2019. Thanks again for joining us, and good night. Cheers.